Brace yourself. Bank of America just dropped a terrifying warning in my inbox. And as you're about to see, it could change everything we know about the markets. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Bank of America's leading strategist said investors are mispositioned for what's coming, even as retail investors double down on big tech. What's coming next will shock investors all over the world. Welcome to our Sunday show, the show that turns market data into dollars, because we're about to break down the latest technicals, momentum shifts, and machine positioning strategies to boost your trading game, and more importantly, put money in your pocket. Now let's over to Bank of America, where we picked today's story with the Flow Show. This led by the leading investment strategist, not just at Bank of America, but in the United States, Michael Hartnett. He says investors are rotating from Magnificent Seven. What he's referring to is institutional professional investors are turning their back on the Big Seven while retail investors go all in. I'm going to show you why he's warning that this is a big problem. It's going to change everything we know about the markets, because when he looks at the tail of the tape, he says he sees a twin peak in both bond yields and US dollars, something investors right now don't see. But there's something I want you to keep in mind. Right now, when we look at year-to-date equity returns, Brazil up 12%. Save this for a little bit, because what he notes is there's no twin peak in gold price. He says that according to their forecast, gold is going to go to $3,000 an ounce. I'd love to know what you think. Many of you I know are buying gold, investing in gold. Weigh in the comments below. Do you think Bank of America is right? Do you see gold going higher? And what's your price target? Because let's dig deeper into what Bank of America says their clients are doing. And right now, they've got a massive 63.3% allocation to equities. Now, this isn't the all-time record high, but not far from it, as again, retail investors continue to buy every pullback in stocks. But he notes their allocation to bonds is now the lowest since July of 2022. And here's the key: international equity markets, just 13% of total equity ETF positions, noting that the Magnificent Seven, again, retail, holding 36% of top stock holdings, while the pros are pulling back. And there's a reason why we're going to show you here in a moment. But let's dig deeper, because he says the big 25 in terms of contrarian trades, he said, are bonds, international stocks, and gold. And why gold? Well, surprisingly, Bank of America notes that not many investors own gold. In fact, their allocation in their portfolio is less than 1%. Can you imagine that? How much gold in your portfolio do you think people should have? Weigh in the comments, because when we talk about twin peaks, what he's looking at here is the 30-year treasury yield. Now, keep in mind, investors think yields are going to go higher and significantly higher, but according to Hartnett's research, he said back in October of 2023, it peaked at 5.1%. In January of this year, you can see it peaked at 5%. He's saying that this is setting up for a massive move lower in yields, down to 4%, if you can believe that. He also thinks that the dollar is setting up another move lower. One of the challenges here is tariffs could cause that little peak in the dollar here to send it even higher. We'll find out soon enough. But let's take a look at what Goldman says, because not only is Bank of America warning here that retail investors are all in on the wrong side of the market, let's take a look at what Goldman has to say, because they too are now weeks away from sending out a tactical bearish note. And this is important to understand, because what are we hearing from investors? Hey, every 2 to 3% drop in equities, you buy and buy some more. And sure enough, that's what Goldman says retail investors are doing. Check this out. Back on January 17th, they saw the largest retail buy imbalance in history, meaning while pros were selling, retail was buying. The second largest took place on February 3rd this year. And on February 4th, it was the fifth largest, meaning 4 of the top 5 retail imbalances in their data set took place in the last 2 weeks, meaning retail investors going all in. The question is, when do they run out of money? Because what is it the pros are looking at? Well, they're looking at the U.S. economy. They're saying maybe it's time to get out. And one of those red flags we've seen is the dollar. We've heard a lot of tech companies starting to warn about this. And let's take a look at the dollar shown in red against the NASDAQ 100, that shown in blue. And what do we see? Periods where the dollar is surging higher. Well, it leads to equity underperformance, as we see here between 2015 and 2016. Look at what happens in late 2018. The surge in the dollar finally catches up to U.S. equities and stocks sell off. Let's move forward to right around 2022. What do we see? The dollar's on this long tear higher. At first, it doesn't impact stocks. Then they come crumbling down. We see it happen again here in 2023. Now, B of A, everyone else warning that perhaps the dollar is going to be a wrecking ball. But it's not just that, it's the U.S. economy itself. Let's take a look at the JOLT survey. This is the job openings and labor turnover survey against the NASDAQ 100. And you can see where job openings go as the red line heads down, the market goes with it. And you see that again during the global financial crisis. And we can go back to 2021 where we see stocks peaked, started to sell off, JOLTS peaked, they came down, and then all of a sudden investors said, no, this is a generational buying opportunity. I've got to get in it to win it. And they took the market higher. Meanwhile, we see a further slowdown in the labor market, and that's validated by earnings, because in the end of the day, what a lot of these pros are warning about is what happens when the retail army runs out of money and cannot buy the dips. Well, that means there's no big buyer because everyone else has been selling. And sure enough, when we take a look at average hourly earnings, this is production and non-supervisory employees in red, and we overlay that against the NASDAQ 100, what do we see? The peaks in equity markets tend to match close to peaks in average hourly earnings. So we can see that deceleration in earnings, and next thing you know, stocks come down. And why does that happen? Well, it's real simple, because when inflation is going up against a recession and wage growth is slowing, that means money has to be spent on, of course, living expenses such as rent and food and energy. Leaves little for discretionary spending, but it also leaves little for investing. And you can see that relationship happen right around 2007. Again, you get that deceleration in earnings, you have inflation rising, stocks peak and go down. Now what are we seeing? Average hourly earnings continue to head lower, stocks head higher, inflation looking to turn up. All the pros are warning, but retail keeps on buying. But they're not the only buyer in this market. In fact, corporates are, but corporates are only buyers as long as they have the earnings and cash flow to do it. But right now, this week, we're going to see 60% of the S&P 500 corporates will have open repurchase windows, and they're going to switch up this week. More companies coming out of blackout window, and this sets us up for 4.64 billion per day on average, which jumps to 7 billion during the open window, which is where we're at now, and drops to 3 billion during closed windows. So for the moment, it's corporate and retail buying into the selling of the professionals. But let's talk about machine positioning here, because the machines command hundreds of billions of dollars, and when they sell, they can drive markets in a big way. And Goldman notes that over the next week, machines aren't big buyers here. They're pretty tapped out. The only way we see machines coming and buying in a big way is over the next month. If there's a big surge in buying, that we see stocks go way up, that the machines could be buying 33.6 billion in foreign equities, a mere 9.28 billion in U.S. equities. And there's some key pivot levels here, and these are where machines sell. We look at the short-term, mid-term, and long-term levels. Now I want you to see this, because this is risk controlled by the machines. Now let's flip over to the S&P 500 chart, and we can see where it closed right here on Friday. See that orange line? That's the short-term pivot level. So what we're hearing from Goldman is saying, look, right now retail and corporates are buying, but we're going to switch our view to bearish, because if we see stock prices break that line, we're going to see machines sell. It'll pull down, likely retail is a buyer again, but if it breaks that second line, watch out. You're going to see a massive amount of selling here in the equity markets. Now let's take a look at the flows here as we look at what's called breadth. And this is important to understand, because this is where we see a lot of that retail flow going into the mega cap 7, and what we see the professionals selling underneath here. And this is called market breadth. Again, we're looking at the percentage of S&P 500 stocks above their 200-day moving average. That is 59%. And look at this. You see market breadth going down. Now in the past, you see where breadth goes, stocks eventually follow. What we're seeing right now is the S&P go sideways last week as breadth weakens, and that's a dangerous sign. Let's take a look at our signals here. We talk about how you can make money in this market. How do you make money trading those technicals, the momentum and machine positioning? Well, this is what we do each and every Sunday. Now I'm going to show you how my subscribers do this. You can grab the links in the description below. Be sure to use a coupon code for the 30-day free trial. But let's take a look at the markets. I'm going to show you how we're making some big money on some of our trades. But let's first look at the S&P 500. Momentum's positive. Now, how do we know that? From a tactical position, we look at something called the relative strength indicator. We want to see it above 40. It's at 51. You look at the MACD, or moving average convergence divergence. It's a positive cross. It's a good sign. Now, our momentum timer pro, we just put out a huge update on this to make the signals even better. It's a massive update, and it changes the game, and it adds a proprietary overlay. And right now it's saying momentum is up for 14 consecutive days. But look at machine positioning, because what Goldman says on their fast fast algorithm, which they trade, we could see a little bit more buying. That's what we see on our fast algorithm. The slow one, which is that kind of longer term over the month window, well, it's saying there could be more buying as well. You notice these aren't maxed out. So what we do is model machine positioning each and every day. We look for discrepancies and position our subscribers in front of that. We also look at those momentum signals here. You can see 14 consecutive daily buying signals on our Momentum Timer Pro. Upside target, where's that? All-time high. Downside target 588. Let's take a look at the charts here of the S&P 500, because the risk right now, as you can see, is machines selling. Problem is, well, retail is buying. And this is the 6-month volume profile. This is where most shares have been traded over a 6-month period. You can see that buyers are beneath, sellers are above it. The problem is buyers are coming in underneath it, and the sellers are eagerly waiting. If you get a break below the 6-month volume profile, a lot of those former buyers turn into sellers. You can see momentum on the RSI and the MACD. They're flatlining here. The trend looks down. Breath says, hey, this thing goes lower. Let's take a look at the tech companies, because what are we seeing in breath here? You see it coming down. So as the big 7 are huge buyers of their stock, a lot of the other companies are not, and that's the risk here. The pros know it. They're unloading these underperforming positions, leaving retail holding the bag, so to speak. And you can see what happens in the past where breath goes, again, price follows. Let's take a look at momentum here. RSI 51, that's a good sign. Positive cross on the MACD, so momentum trending to the upside here. In fact, we've got 4 consecutive daily buy signals on our momentum indicator. Look at machine positioning. Once again, what do you see? Fast algorithm is mostly long, can go a little bit more, just like Goldman suggested. What do you see on our slow algorithm? Validating over the next month. If you see higher stock prices, yes, the machines are going to buy. We give you the lead on that because we do a historical overlay on machine positioning, so we know where they're likely to head before they get there. Now let's take a look at the charts here and see what's going on with QQQ. Now you'll note the 6-month volume profile, there's a little bit of room to work here, but notably what happens? All these buying moves up, what happens? They run right into sellers. That's the pros here, stalling the market. What you're looking for is retail to beat them and drive the professionals back in. What the pros are looking to do is get retail to beat net sellers here. As far as momentum goes, it's holding flat. Let's talk about small caps here, because what do we see? Breath against their 208 moving average, now only 52% above their 200. What do you see? It's rolling down. Stocks here on the small caps rolling down, and you can see the great relationship between breath and stock prices on the IWM. Momentum here still positive. RSI have been cooling off a little bit here at 49. MACD still got a positive cross, but the question is for how much longer? Once again, our machine positioning right in line with what Goldman's telling us. Where do we see the next upside target? Well, that's unchanged at 232. Downside target is 220. Let's take a look at the chart and see what's going on with IWM, and it gets into the supply zone. Now, what is a supply zone? You see these 2 purple lines. This is a zone where we previously identified where people are either buying or selling. Now, usually sellers are to the upside, so price goes up and it runs into sellers. You go down and you find a buy zone below, and right now, every time the buyers come in and shove price into that sell zone, there's eager sellers awaiting. We're seeing, again, on the RSI, it's going flat. MACD looks like it's about to cross to the downside and roll over, clearly suggesting that the next direction for small caps is right down into that 6-month volume profile. The question is, how long does the retail army have to continue to buy? Let's talk about the energy sector. We've made money on this, in fact, quite a bit of money, and then we told our subscribers to get out. How about this? Momentum now negative. RSI is at 45. MACD's got a negative cross, but our proprietary indicator is telling us this is a massive sell signal here. And look at machine positioning. It's backed off that big long position. Not long ago, we rode this to a max long across the board. Momentum was surging higher. Upside target, I think this is a fantasy, 93.28. Downside, 86.23. Let's take a look at XLE here and see where it is going, because what do we see? The 6-month volume profile, that's a sign of resistance. And all these people that bought in here, well, if they're holding the position, they're going to be sellers. Now, we told our subscribers to why way back down in here. We had them sell right up in here. Show you how to do that too. Look at momentum. Clearly RSI trending now. Same with the MACD, meaning price heading lower. Downside target 86.23. If we get to there and we break down, then you're looking at the recent 6-month lows, 82.75. But how about financial stocks? We've made some money on this, but we got stopped out on February 3rd. This was to our Momentum Timer Pro subscribers on that really volatile day. We moved our stop loss levels up. We said, look, it's not worth taking the risk here. But how about machine positioning, it's max long the financials. Momentum is very long financials. The riskier as they go higher, but this isn't something we want to chase, because remember earlier I told you, hang on to that notion of Brazil. Look at this. Back on January 16th, we put a buy it open to our CTA and Momentum Timer Pro subscribers. That trade up now 6.96%. And remember at the beginning of the show, I noted that Bank of America said that Brazil was its top performer year to date. Our subscribers all over this. And again, you too could take advantage of this and make money in the markets. What do we see? Momentum is trending higher. Machine positioning max long. This is our live stop loss level. And yes, we do give our subscribers risk control levels to help them control their downside exposure. Let's take a look at Brazil here, EWZ. And what do we see? We told them to buy down in here, and now they're taking off up here, looking for the next move up to the 100-day moving average, is creating a little bit of support into this volume zone here. If it breaks out to the upside, of course, we'll raise our stop loss levels. But B of A also noted the bond market could be a source of big returns. Right now, our TLT trade is down 4.72%. Why so much? Because we show you what happens if you don't trade with stops and positions go the wrong way. You just dollar cost average until you get where you want. Back on January 31st, we added another position here. You'll notice it dropped our cost basis down. Upside target 91.67, downside target 88.04. What are we looking for? Those slow algorithms to pick up and give us a tailwind of machine buying here. Let's take a quick look at TLT and see what's going on with the long bond, and that is a bunch of support right here under that 6-month volume profile. Now, what does this mean? Is it likely we could see price pull back into this volume here? Yes, that is absolutely possible. If it does, well, that would be in a point where you'd want to look to add to that trade, because if it holds a 6-month volume profile, your next upside target is the 100-day moving average. And look at this, RSI up, MACD up, everything pointing to a rise in bond prices. Let's take a look at gold. Remember, people said gold's going to go to new highs. They said if you like gold, we'll buy this instead. How about our GDX trade time? 11.46%. Our CTA Timer Pro subscribers loving that. Here's our live stop loss levels. Again, we update them as we need. Plus, every weekend we go through all of our stop levels to make sure all of our subscribers are on point. How about this? Upside target now 42. Downside target revised as well. Machine positioning long, of course. Momentum long. That's exactly what we'd expect to see. But let's take a look at GDX here, because remember, this was a big trade for us. We said buy back down in here and ride it up here. Next upside target is just 42. Let's zoom out to the 1-year chart, and we can see we're looking at just a little bit higher here with the potential breakout up to 44. Again, if gold continues higher, watch the miners continue to run with them. Put money in our subscribers' pockets. Could put money in your pocket too. Grab the links in the description below. Let's talk about a recent trade we put on February 4th on wheat. And again, all we're doing here is trading the technicals with Momentum Timer Pro and our updated algorithm. That trade up 3.85%. We've got 9 consecutive daily buy signals. Let's take a look at this wheat trade, because my friends, this is how simple it is to trade. We give you the signals, we tell you which ones you should trade, and all you have to do is buy them. Now, we picked this trade up back on February 4th. We said, hey, it's got some limited upside, but it's taken off. Right now, our next target is the 200-day moving average. And what are we telling our subscribers to do? And that is raise your stop loss level. Right now, it is at our buy price, but we're going to look to raise that if price continues to move higher. But let's talk about the dollar. Now, Bank of America says dollar goes down. Well, maybe it goes higher. Let's take a look and see what the charts have to say, because according to our screens, momentum is negative, but machine positioning has moved to buy here. Let's take a look at the chart and see where the dollar goes, because right now it's holding support at its 6-month volume profile, my friends. That is a very clear signal. If it continues to hold this, the short-term move of the dollar is higher. Bank of America said it eventually goes lower. That means the next target is the downside, the bottom of that 50-day moving average in green. But for the moment, this is a bullish setup for me here that tells us the dollar could head quite a bit higher. But again, if you want to make money trading these markets, again, it's just as simple as grabbing those links in the description below, getting those coupon codes, and start trading, start making money. We make it easy for you. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.